We often think that investing in the stock market is a math problem, that if you can just find the right metrics and right valuation, your problems are solved and you can figure out the next, 100x stock. But what if I told you that it's more about your behavior than anything else that determines how successful you are in the stock market and investing in the stock market? So I recently read a book called The Psychology of Money by Morgan Housel. And I want to go through 5 major takeaways that I took from this book and how it can be so valuable to investors and traders alike. So with that, like and subscribe, leave comments down below, let me know what you like and dislike about this video, and let's get into it. Your outcomes in investments is not solely due to effort and skill. Luck and risk also play a critical role in how well you do. So success isn't always genius and failure isn't always laziness. There's so many other variables in play. So you have to see the importance in recognizing what's truly within your control and what's not in your control. So these are things like savings rates and long-term thinking and how you act with your money. You go out and spend the money as soon as it comes in. Things like this. So those are within your control, within your behavior. So if you can control those and choose to focus on those, just ignore the things that you can't. You can't control if Argentina raises their interest rates 5%. That is totally not in your control. So only focus on the things in your control. The book gives an example of this with Bill Gates. So Bill Gates speaks openly about this, and he said that his early access to computers, just totally something that is just a lucky break, because he had no control as a child. He had no control in what his school had in terms of their library or their computer section. But what he chose to do with that was in his control. He chose to use that lucky break. He chose to use that access to computers to build Microsoft as it is today with his co-founders. So the actionable takeaway from this point is that you have to stay humble in your success, be compassionate in your failure, and focus on robust strategies that are in your control, not just optimizing for perfect conditions. That way you can take into account luck and risk into your investing and not just leave it up to effort and skill, which are also important, but not the only factors in what determines your ultimate success. So life is inherently unpredictable. Financial plans, therefore, shouldn't aim for a perfect efficiency or maximum returns at all cost. Instead, they should incorporate a margin of safety to withstand these inevitable shocks to the market, to the global markets. The world is so wild. Think about like the last few years, and you'll see global pandemics, inflation spikes, geopolitical crises, and all of these are continuing. There's tariff drama right now. There's so many things going on in the world. No one can predict these things. No one can perfectly predict these things. So planning for a smooth, uninterrupted future is like setting yourself up for disappointment and potentially financial ruin. What you need is that cushion. You need emergency funds set up, having cash reserves for unexpected job loss, medical bills, or home repairs, and just to add to the market when things downturn. Inevitably, there will be a bear market in the future. So adding money to those stocks, those value stocks, those undervalued stocks at that time, maximizes your gains. Diversification. If you don't put all your eggs in one basket, you will have much more safety in a breadth of investments rather than just sitting in one stock, putting all your eggs in one basket. And having a conservative mindset when it comes to budgeting and projecting returns, so that you're pleasantly surprised and not disappointed when you... So you have to survive in these markets. When a downturn happens, when a bear market happens, If you do not have any cash, you are effectively out of the market. You cannot get into the market because your existing holdings, the holdings that you already have, are going to be hit by the downturn. You're not going to be able to build anything. You're not going to be able to create life-changing wealth if you're out of the market and you're not invested or not investing while the market is providing you the best deals for years to come. So chasing the absolute highest returns often means taking excessive risks and eliminating your room for error. So sometimes good enough is better than just perfect if it means you're still in the game. So the actionable takeaway from this point is prioritize building financial resilience over maximizing every last cent. So like, there's no way you're going to get the top of the market, no way you're going to get the bottom of the market. But can you DCF? And can you leave room for error during those curves? Yes. And plan for those contingencies? You can absolutely do that. So build that emergency fund, diversify your investments, and avoid financial cliffs. So compounding is magic. And this is the next point. This is the simple but really powerful idea that your earnings will earn on those earnings. So it's kind of like the snowball effect. So it's not about being a genius. Warren Buffett said that you don't need to be a genius to do what I do. And this is the idea that I want to convey, and it's from this book also, that you don't need to be a genius to pick stocks or like be a financial savant to get a great return in the market. The magic of compounding works for everyone. It's the same for everyone. But what's really crucial is the time that you take to feed into that compounding machine and being patient with those investments. So if you do with this, you can do a small effort and get huge results years later. And it's all about doing those consistent, modest saving habits and investing habits that can easily outperform sporadic, larger term investments later on in life. So it's kind of not intuitive, but our brains are thinking linearly, but compounding goes exponentially. And this makes it really hard to grasp intuitively because we as humans we want things fast in this day and age. We want quick returns. We want to trade in and out. A large portion of us want to trade in and out for quick gains and then move on to the next thing. But the way this works, the way to make truly life-changing money in almost all cases is to be patient and let your money work on building on itself, which is called compounding. Price is what you pay and value is what you get. And the core idea here is there's a crucial distinction between the price you pay for something and the value you actually derive from it. So smart financial decisions prioritize value over just focusing on a low price or like a really good story without a moat. So here in this book, it's implied that people often confuse an expensive price tag with a high value or a cheap price with a good deal. Sometimes the most expensive things provide very little value, and sometimes the very simple things provide immense value. And that's what we're going for, the latter. This means a stock may be cheap in price, but still be a bad investment if the underlying company has low growth, low revenue, low margins, lack of a moat. But conversely, a high price stock might be an excellent investment if its growth potential and quality are immense and high value. So this applies to asset classes too. You just don't chase whatever's on sale without understanding the underlying worth behind that investment. So the actionable takeaway for this point is before making any significant investment, you should ask yourself, what is the true value that I'm getting from this? Just beyond the price that I paid, the stock price that I paid at the time. Because that's really only a snapshot. And if you want to know the true value of the company, Bearded Investor has the stock valuation software that's going to roll out in the next few weeks. That's a slight plug. But prioritize investments that align with your genuine story, moat of the company, and intrinsic value of the company. Our society often defines wealth by visible displays of consumption, and we're talking about big houses, fancy cars, designer clothes, on and on and on. But in this book, it's argued that, however, in this book, it's argued that the true wealth is the money you don't spend. It's the assets you accumulate that give you freedom and time, and freedom of time and effort and energy. So this is called man in the car paradox. And Housel describes this as someone in a fancy car thinking that other people watching him saying, oh, this person's rich. But what they're actually seeing is the money that person just spent. So all those people know of this person in a fancy car is that he or she spent $100,000, $200,000 on this supercar, and they don't have that money anymore because they just bought something with it. So the true wealth is the money the car owner didn't spend. The money is in their investment accounts or in the equity of their home. So every dollar saved and invested is a dollar that could have been spent on something visible, but wasn't. This accumulation of unspent money is what quietly builds financial security and future potential. Warren Buffett famously still lives in the same house he had in 1950. He's a multi-billionaire, but he hasn't upgraded his house. He has quietly accumulated, and now it's visible because he's accumulated so much money that he just quietly accumulated this money and let compounding do its work over decades. And that's why he's so rich. The real benefit of wealth isn't about buying more stuff. It's about buying freedom. Freedom to choose where you work, how you work, freedom to take time off or work in general, freedom from financial stress, and freedom to help others, charitable work, or just helping your family and friends. So the actionable takeaway here is resist the urge to show off. Just because your friends got some new fancy car doesn't mean you need to get that fancy car. You don't need to get a watch or the latest gadgets to show off to these people. It doesn't matter. Understand that true financial independence comes from what you accumulate, not what you consume. So thank you guys for sticking with me to the end of this video and learning about the 5 major points that I took away from The Psychology of Money by Morgan Housel. And if you want to learn about this book or read this book, I've pinned a link down in the comments below. And let me know what you think of this book and any takeaways that you get out of this book, because I'm really interested in hearing about other people's perspectives about finance and investing and stocks and things like that. So that's about it for this video, guys. Like and subscribe and leave those comments below.